Most traders never expect this to happen. They believe that the more they learn, the better they will trade. More books, more courses, more indicators, more strategies, more market knowledge. On the surface, that sounds logical. In almost every profession, learning compounds into mastery. But trading is different. And that difference is why so many traders reach a disturbing point in their journey, where instead of improving, their performance actually deteriorates. Their win rate drops, their confidence erodes, their execution becomes hesitant. They hesitate on good trades, chase bad ones, and overthink everything they do. They don't feel ignorant anymore. They feel overloaded. If you've ever caught yourself saying, "I know more than I used to, but I trade worse now," this video is for you. Because this isn't a motivation problem, it isn't a discipline problem, and it isn't because you're not smart enough. It's because learning, in trading, can quietly turn into a liability. The paradox is simple but uncomfortable. Knowledge doesn't automatically create clarity. In trading, it often creates noise, and noise is lethal when decisions must be made under uncertainty, pressure, and time constraints. Most traders think the enemy is lack of knowledge. In reality, the enemy is unintegrated knowledge. And until you understand why, you'll keep adding tools to a system that's already collapsing under its own weight. Let's slow this down and look at how this actually happens. Almost every trader starts the same way. You learn a basic setup. Maybe it's a simple price action pattern, a moving average crossover, or a breakout strategy. At first, it feels clean. The rules are clear, you see opportunities everywhere. You execute without hesitation. Then the losses come. And instead of questioning execution, you assume the system is incomplete, so you add more. You learn RSI to filter entries. You add MACD for confirmation. You study market structure, then smart money concepts, then order blocks, then liquidity sweeps, then correlations, then macro fundamentals, then sentiment, then options flow, then algorithms, then AI models. Then someone on Twitter shows you a new edge. Individually, each concept makes sense. Collectively, they begin to conflict. Now, every chart looks like a battlefield of opinions. One indicator says buy, another says wait. Market structure says bullish, liquidity says trap. Your system says enter, your memory of past losses says hesitate. This is the first critical mistake most traders make, even though it doesn't feel like a mistake at all. They confuse learning with progress. They assume that accumulating more information will naturally refine decision-making. But trading doesn't reward information density. It rewards decisiveness under uncertainty. And the more unfiltered knowledge you stack, the harder decisiveness becomes. Here's the uncomfortable truth. Markets do not reward those who know the most. They reward those who can act clearly with limited information. This is where pain starts to show up. You hesitate at entries you would have taken instantly months ago. You wait for confirmation that never comes. You miss good trades and enter late. You reduce size on high-quality setups and increase size emotionally after frustration. You don't feel ignorant anymore. You feel mentally congested. And the worst part is this: when performance declines, your instinct is to learn even more. You dive deeper into content, you buy another course, you tweak your system again. This creates a feedback loop where knowledge feeds confusion, confusion feeds poor results, and poor results drive even more learning. At this stage, trading stops being execution-based and becomes interpretation-based. Every trade turns into a debate instead of a decision. This is not because you lack discipline. It's because your decision framework has collapsed. You no longer know which information deserves authority at the moment of execution. And that brings us to the deeper pain most traders avoid confronting. Trading punishes intellectual pride. Many traders secretly believe that if they just become knowledgeable enough, uncertainty will disappear, that one day the market will finally make sense, that enough study will turn probability into certainty. But markets never remove uncertainty. They only expose how you respond to it. The trader who keeps learning without integrating is not becoming more prepared, they are becoming more fragile. Because every new concept introduces another condition, another exception, another reason to second guess. And when pressure arrives, fragility shows up as hesitation, overtrading, or paralysis. This is why some traders with 5 strategies trade worse than traders with 1. Not because the strategies are bad, but because the mind cannot prioritize under stress. More knowledge did not create more edge, it diluted it. This is the point where most traders blame themselves. They think something is wrong with their mindset, their discipline, or their confidence. But the real issue sits deeper than mindset. It sits in how the brain processes conflicting frameworks under risk. And until you understand that mechanism, every attempt to fix your trading will only add another layer to the problem. This is where the real mistake begins. What most traders don't realize is that the moment they start trading worse despite learning more, they've crossed an invisible threshold. Up to a certain point, knowledge helps. It gives structure, it reduces randomness, it builds basic competence. But beyond that point, something changes. Learning stops being additive and becomes corrosive. This is where the real mistake reveals itself. The mistake is not overlearning. The mistake is learning without a hierarchy. In trading, not all information deserves equal authority, but most traders treat it that way. Every concept they learn is allowed to speak at the same volume inside their head. Indicators, price action, market structure, fundamentals, correlations, sentiment, everything competes for control at the exact moment a decision is required. The brain cannot resolve that conflict fast enough under risk. Neuroscience is very clear on this. Under uncertainty and potential loss, the brain prioritizes survival over optimization. When too many variables are present, the prefrontal cortex, the part responsible for rational decision-making, starts to shut down. The emotional centers take over. This is why traders don't freeze because they lack confidence. They freeze because their brain is overloaded. Think about this carefully. When a setup appears, your mind doesn't ask, "Is this trade valid?" It asks, "Which framework should I trust right now?" That question alone is enough to kill execution. You hesitate not because the trade is unclear, but because your internal authority is unclear. You don't know which rules outrank the others. So the safest option becomes inaction, or worse, late emotional action. This is why traders who know less sometimes trade better. They're not smarter, they're simply operating with fewer internal conflicts. Now here's the part that makes this even more dangerous. Most traders assume that the solution is to simplify, so they delete indicators, they switch strategies, they start over again. But simplification without understanding hierarchy just resets the problem temporarily. It doesn't solve it. The real issue is not how much you know, it's how your knowledge is organized. This brings us to the moment of revelation that changes everything. Professional traders, whether discretionary or systematic, do not operate with dozens of equal inputs. They operate with one primary decision framework, supported by secondary filters that never override the core logic. That hierarchy is the difference between clarity and chaos. A professional does not ask, "What does everything say?" They ask, "What matters most right now?" Price might be king, or structure, or volatility, or risk context, but whatever it is, it sits at the top. Everything else is subordinate. Retail traders almost never build this hierarchy. They collect tools, not systems. They accumulate perspectives, not rules of authority. This is the turning point. Once you understand that trading is not about knowing more, but about deciding which knowledge has veto power, the entire problem reframes itself. You stop asking, "What else should I learn?" You start asking, "What should I ignore?" That shift is uncomfortable because ignoring information feels irresponsible. It feels like leaving edge on the table. But in reality, it's the only way execution survives. This is where most traders finally realize the truth. Markets are not complex because they have many variables. They are complex because you cannot act on many variables at once. Edge comes from reduction, not expansion. And now we can finally talk about what's really happening when traders say, "I trade worse the more I learn." They are not becoming worse traders. They are becoming unexecuted analysts. Their thinking improves. Their decision-making collapses. This is why so many traders can explain markets beautifully, but cannot trade them profitably. Explanation and execution are governed by different cognitive processes. One tolerates ambiguity, the other demands commitment, and commitment requires authority. If your system does not tell you explicitly which input has final say, your mind will keep searching for certainty that does not exist. That search never ends. This is not a personality flaw, it's a structural one. Once you see this, the path forward becomes much clearer. But clarity alone is not enough. You need a way to rebuild your trading around this insight without falling back into the same trap. That's where application begins.
The core mechanism that destroys traders as they learn more is not psychological weakness. It is decision dilution. Trading is a probabilistic activity that requires commitment under incomplete information. The moment you press the button, you are accepting uncertainty. No amount of knowledge removes that requirement. It only changes how you justify the decision afterward. Here is what happens beneath the surface. Every trading concept you learn is a model. Indicators are models. Market structure is a model. Smart money concepts are models. Fundamentals are models. Even price action itself is a model of interpretation layered on top of raw data. Models are not reality. They are filters. When you start trading, you typically operate with one or two simple filters. The signal passes through quickly. Execution is clean. As you accumulate models, each one demands validation. Each one introduces a conditional statement. If this is true, then maybe I act, unless that is also true. This creates what professionals call conditional paralysis. The trade is no longer decided by edge, it is decided by internal debate. Here's the key insight most retail traders never reach. Edge does not come from confirmation, it comes from prioritization. Institutional traders understand this deeply. A discretionary trader at a prop desk does not stack 20 confirmations before entering. They operate within a narrow decision box defined by one dominant variable, often volatility regime, structural context, or liquidity condition. Everything else is informational, not authoritative. Retail traders invert this relationship. They allow secondary information to override primary signals. They treat every learned concept as a veto. The result is a system where nothing ever fully qualifies. Now let's ground this in a concrete case. Consider a trader who learns smart money concepts after years of indicator-based trading. They now see liquidity sweeps everywhere, stop hunts, inducements, false breakouts. This knowledge is powerful, but only if integrated correctly. What usually happens instead? A clean setup appears. The system rules are met, but the trader hesitates. What if this move is just a liquidity grab? What if this breakout is engineered? What if smart money is fading this? Notice what changed. Smart money concepts were not added as a filter. They became a universal override. Every trade is now suspect. Every signal is guilty until proven innocent. But proof never arrives because markets don't provide certainty, only outcomes. This is how learning turns against the trader. Now, scale this across multiple frameworks. A trader knows macro fundamentals, so technical signals feel unreliable. They know correlations, so isolated setups feel dangerous. They know market manipulation narratives, so every loss feels rigged. The trader is no longer trading the market. They are trading their internal commentary, and commentary has no edge. Here's the uncomfortable truth. Markets reward coherent decision systems, not accurate worldviews. You can be wrong about many things and still make money if your system is internally consistent. You can be right about many things and still lose if your system cannot execute. This is why professional systems are deliberately narrow. They define when information matters, when it is ignored, and, most importantly, when action is mandatory despite doubt. Retail traders rarely define the third condition. They believe that learning more will eventually remove doubt. In reality, doubt is structural. It never disappears. Professionals simply stop negotiating with it. Another critical mechanism is post-trade distortion. The more you know, the easier it becomes to rationalize outcomes after the fact. You can always find a reason why a loss made sense or a win was obvious. This creates a false sense of understanding without improving forward decision quality. Learning feels productive because it explains the past. Trading requires commitment to the future. These are different cognitive tasks. The final piece of this puzzle is identity. Many traders unconsciously shift from being decision makers to being analysts. Analysis feels safe, it feels intelligent, it feels controlled. Execution feels exposed. When learning increases without corresponding rule compression, the trader's identity drifts. They become someone who explains markets rather than acts in them. This is why many highly knowledgeable traders secretly avoid execution. They stay in preparation mode. They optimize endlessly. They research continuously. Learning becomes a form of procrastination disguised as professionalism. At this point, trading performance declines, not because the trader lacks edge, but because edge is buried under excessive cognition. The solution is not to unlearn, it is to compress. Professional traders periodically destroy information. They deliberately remove variables. They strip systems down until only the variables that actually change outcomes remain. This is uncomfortable because it feels like regression, but it is actually maturation. The traders who survive long-term are not those who know the most. They are those who know what not to consult when risk is on the table. Until a trader builds a hierarchy where one signal has authority and others are contextual, learning will continue to sabotage execution. This is the real reason you trade worse the more you learn, not because knowledge is bad, but because unstructured knowledge is incompatible with decisive action. And unless that structure changes, no new strategy, indicator, or insight will ever fix the problem.
The practical question now becomes unavoidable. If learning more can make you trade worse and unstructured knowledge destroys execution, what do you actually do about it without throwing away everything you've studied? The answer is not to become ignorant again. It is to become selectively blind. Application starts with redefining what your trading system is allowed to do. The first principle is authority compression. You must decide explicitly which variable has the final say in your trading decisions. Not 2, not 3, 1. That variable might be market structure. It might be volatility regime. It might be time-based context. It doesn't matter which one you choose. What matters is that once a trade reaches execution time, only that variable has veto power. Everything else becomes advisory, not decisive. This single change does something most traders never experience. It restores decisiveness without removing intelligence. The second principle is decision time ignorance. There is information you are allowed to use during preparation and information you are forbidden to consult during execution. Professional traders separate these phases deliberately. Preparation is expansive, execution is restrictive. If a piece of information does not change your action with statistical consistency, it does not belong in execution. You may understand it, you may respect it, but you do not consult it when risk is live. This rule feels dangerous at first. It feels like ignoring reality. But in practice, it is what allows action under uncertainty. The third principle is post-trade accountability without reinterpretation.
After a trade, you do not explain outcomes using new frameworks. You evaluate only whether you followed the hierarchy you defined. Most traders evaluate outcomes. Professionals evaluate adherence. This prevents learning from becoming retroactive justification. It forces knowledge to improve future behavior, not narrative comfort. If a trade loses but followed the hierarchy, it is a valid trade. If a trade wins but violated hierarchy, it is a failure. This rule alone eliminates a massive amount of self-deception. The fourth principle is concept quarantine. When you learn something new, it does not get immediate permission to influence trading. It must be isolated, tested, and proven within your existing hierarchy. Retail traders integrate instantly. Professionals quarantine first. This slows learning, but dramatically increases its effectiveness. The final principle is identity realignment. You must decide whether you are an analyst or a trader. Analysts explain markets. Traders commit capital. There is nothing wrong with being an analyst, but pretending to be both at the same time is where performance collapses. If your identity rewards insight over execution, you will always drift back toward overlearning. Your system must reward action aligned with structure, not intellectual satisfaction. When these principles are applied, something subtle but powerful happens. Learning stops feeling urgent. You no longer chase knowledge to fix discomfort. You no longer search for certainty that doesn't exist. Your system becomes quieter. Your decisions become faster. Your outcomes become more consistent, not because you predict better, but because you execute better. This leads to the final lesson. Trading is not a test of intelligence. It is a test of authority under uncertainty. The market does not reward those who know the most. It rewards those who can act clearly when knowledge conflicts. If you are trading worse the more you learn, it is not a sign that you are failing. It is a sign that you are at the edge of a deeper transition, from accumulation to integration. Most traders never make that transition. They stay trapped in endless preparation, mistaking explanation for edge. If this video helped you recognize that pattern in yourself, pause for a moment before you look for the next piece of information. Ask a harder question instead. What am I allowing to override my decisions that should no longer have authority? That question alone can change how you trade more than any new strategy ever will. If you want more breakdowns like this, where we strip trading down to the mechanisms that actually control outcomes, subscribe to the channel and stay with us. This is not about finding more answers. It's about learning which answers to stop listening to.